Welcome to the deep dive. Today we're diving into a topic that sits right at the intersection of cutting-edge AI and your wallet. Can advanced AI agents actually give you good financial advice, specifically within a market like Thailand?
That's the big question, isn't it? And this deep dive, it's based entirely on insights from a specific research paper that really put this whole idea to the test. It's a fascinating look at how these AI agents were built and, how they performed.
Okay, so our mission here is to unpack this research for you. We'll explore what makes these AI agents different from, say, standard chatbots. We'll see how they stacked up when tested in the Thai capital market, and maybe most importantly, find out what real people thought about, well, trusting them with their money.
And yeah, we've definitely got some numbers on performance, plus insights from a human survey that are, frankly, pretty surprising. Raises some big questions about the future of financial advice, I think.
Okay, let's start with the basics then. Unpack this idea of AI agents. Many of you listening are probably familiar with large language models, LLMs. You know, the tech behind tools like ChatGPT. You give them a prompt, they give you an answer, usually one step.
Right. But here's where it gets really interesting. The AI agents in this research, they're presented as a pretty significant evolution from those standard LLMs. They don't just work in a single step. It's a much more complex kind of iterative process.
So they can kind of break down a problem and work through it step by step.
Exactly. Think of it like they're doing more than just spitting out text. They're like executing a multi-step plan. And crucially, they can use tools.
Tools? What kind of tools? Like software tools?
Yeah, exactly. Digital tools or external capabilities. The paper mentions them using things like search engines. They can hit Google search for real-time info, for instance, or pulling data from specific financial databases, maybe even custom software built for market analysis. This ability to, interact with the outside world. That's a key difference from a basic LLM just working off its training data.
Okay, so they can access current info. And you mentioned they can work together.
Yes, that's the collaborative piece. The architecture can involve multiple agents. Maybe one agent specializes in news analysis, another in risk assessment. They coordinate to achieve a more complex goal. This layering, the tool use, the collaboration, that's why the paper suggests they might achieve, higher accuracy than simpler LLMs.
And this isn't just theory, right? It's happening now.
Apparently so. The source points to a November 2024 survey, U.S. companies, where over half already had AI agents in production.
Wow, over half.
Yeah, and over 3/4 were actively developing them for future use. So the real-world adoption is really picking up speed. The paper even gives a specific example, Portfolio Pilot. An AI-driven financial advisor uses agents, raised like $2 million, offers portfolio evaluation, stock picks, that kind of thing.
All right, that paints a clearer picture of what these agents are. So now let's zero in on this specific study. It's applying this tech as financial advisors, specifically in the Thai capital market.
Exactly. And this is where the research fills a bit of a gap. We've seen robo-advisors, sure, and even some LLMs trying basic stock predictions. But this study is presented as, well, the first to apply these more advanced AI agents, designed as financial advisors, specifically within the Thai market context, focused on the SET, the Stock Exchange of Thailand.
And what exactly were these AI agents supposed to do in the study?
The main jobs were monthly stock selection, picking stocks from the SET 100 index, and also customizing investment strategies based on what a user wants. Things like your investment style, growth versus income, and your risk tolerance, low or high.
Got it. And the time frame they looked at?
They focused on SET 100 stocks from the December 2023 list and evaluated performance over 1 year. That was November 2023 up to October 2024. The paper mentioned that this time frame was partly because of the LLM they use, GPT-4 Mini. Its knowledge cutoff was October 2023, so it influenced the study period.
Okay, makes sense. So let's connect this back to the listener. Why should you care about this research? What's the potential so what here?
I think the biggest potential benefit the study really highlights is just cost. Simple as that. AI agents could potentially provide pretty sophisticated financial advice at a much, much lower cost than you'd pay for a traditional human advisor.
Right, which immediately opens doors, increases accessibility.
Absolutely. This lower cost option could bridge a huge gap, making professional level guidance available to way more people, folks who might feel, priced out right now. And the paper even suggests this wider access could help improve financial literacy in Thailand overall.
And maybe even help people avoid risky ventures or scams outside the regulated market.
That's a potential positive side effect, yeah. If sound advice is easier and cheaper to get, it empowers people. It could steer them towards safer, more formal investment channels.
Okay, so those are the potential upsides. Let's get into the nuts and bolts. How did these AI agents actually work? What data did they use?
So they were fed two main types of data. First, your standard historical market data. Think prices, PE ratios, dividend yields for those Set 100 stocks, collected from places like Bloomberg, SetSmart, Investing.com. Usual suspects.
Okay, historical numbers. And the second type was news.
Yep, financial news. Specifically, a massive data set like 35,615 news headlines related to Set 100 stocks. They scraped these from the SetTrade website covering various Time media outlets.
35,000 headlines. Did they, analyze the sentiment? Good news, bad news?
They did, yeah. Their analysis found most headlines were actually neutral, about 49%. Then good sentiment was next, around 43%, and only about 8% were seen as bad. So definitely more positive or neutral news than negative during that specific period they looked at.
Interesting balance. Okay, so they have the historical data, they have the news sentiment. How did the agents actually process all this? Can you walk us through the workflow?
Sure. Picture this. It starts with what they called a stock advisor agent. Its main job: sift through all those thousands of news headlines we just mentioned, analyze the sentiment, the content, and from that, it generates an initial list. Maybe the top 10 potential stocks that look promising based purely on that news flow.
Okay, so it narrows it down from 100 to 10 based on news. What happens next?
Then, the investment customizer agents step in. This is where that collaboration and tool use really comes into play. You have these specialized agents like a risk advisor and an investment-style customizer. They take that list of 10 stocks from the first agent.
And this is where the user preferences like low risk or growth investing come in.
Precisely. Based on the prompts you'd give the system, I want low risk or focus on growth, these customizer agents use that input. But they also analyze the historical market data for those 10 stocks. They combine user preference with data analysis to refine the list down further to the final top 5 stocks tailored just for you.
So it's a multi-step process, combining different types of analysis and personalization.
Exactly. It's that multi-agent collaborative refinement we talked about earlier.
That makes sense. A neat way to blend it all. Okay, so once they had these customized lists of 5 stocks, how did they figure out if the AI was actually any good at this? Let's start with the performance, the hard numbers.
Right, the quantitative part. This looked at portfolio return and risk over that 1-year test period. And of course, they needed something to compare it against. A benchmark.
And the benchmark was just the Set 100 index itself, like a simple index fund approach.
Pretty much, yeah. Specifically, an equally weighted Set 100 portfolio. And it was rebalanced monthly, just like the AI portfolios, to make it a fair comparison against a basic passive strategy.
Okay, moment of truth then. What were the results? Did the AI actually beat the benchmark?
This is where it gets pretty compelling. Over that 1-year period, remember, November 23 to October 24, the high-risk AI portfolio, it generated a 7.36% annual return. Pretty decent. The low-risk AI portfolio returned 0.74%. Still positive. Now compare that to the benchmark, the equally weighted Set 100. Over the same period, it had a negative return, minus 1.68%.
Wow, okay, so that's quite a spread. Both AI portfolios didn't just outperform, they made money in a period where the simple benchmark actually lost money.
That's what the numbers showed for this specific year, yes. Strong relative performance. And they also looked at risk, of course. They used measures like maximum drawdown and annual standard deviation.
Right. Can you quickly remind us what those mean again, for anyone not living and breathing finance terms?
Sure thing. Maximum drawdown is basically the biggest drop your investment experienced from its highest point to its lowest point during the period. Think worst-case loss scenario within that time frame. An annual standard deviation that measures volatility, how much the returns bounce around the average. Higher number means more ups and downs, generally seen as higher risk.
Got it. Peak to trough drop and the bounciness. So how did the AI portfolios do on risk?
Well, the low-risk AI portfolio did really well here, actually. It showed lower risk than the benchmark on both counts. Its max drawdown was about 11.5%, whereas the benchmark dropped over 20.5%. There's a big difference. And its standard deviation, the volatility, was lower too, about 11.9 versus 15.4 for the benchmark.
Okay, hold on. So the low-risk AI portfolio was less volatile, had smaller dips than the overall index, and it still delivered a positive return when the index was down. That sounds like exactly what you'd want from a low-risk strategy.
It certainly aligns with the goal, yes. A very compelling result for that strategy in this test. The high-risk AI portfolio. Well, it had a slightly better max drawdown than the benchmark, around ANIX 18.7%. But as you'd expect for high risk, its standard deviation was higher, about 17.6%, more volatile. So overall, the quantitative results suggest the AI agents did manage to outperform on return and customize portfolios effectively to different risk levels. The paper even has a chart, figure 7, that shows the portfolio wealth growing over time, visually demonstrating that difference.
Okay, the numbers look promising, at least for that 1 year period. But, investing isn't purely about math. There's the whole human element, trust. How did the study tackle the more qualitative side? Like, would people actually trust these AI agents with their money?
Yeah, this is a really critical piece. Because, let's face it, there are growing concerns about AI being a black box, especially generative AI. The paper cites a McKinsey survey where, like, 40% of companies saw explainability, understanding why the AI does what it does is a key risk.
So how did they try to measure that trust and explainability?
They did a survey. Participants were shown the actual news headlines the AI agents used, and they were shown the AI's own generated explanations for why it picked certain stocks. So, for example, they might see headlines about GULF, a Thai energy company, expanding into solar power, and then see the AI's write-up saying, we picked GULF because of its expansion into solar, strong market position, and recent deals, linking the decision back to the news. This allowed people to judge the AI's reasoning for themselves.
Okay, that's a smart way to do it. See the inputs and the explanation. So what was the verdict? Did people buy the AI's logic?
The overall vibe was generally positive. Participants mostly agreed that the AI's news analysis and its reasoning seemed reasonable and consistent with the data we've shown. You got a mean score of 3.5 out of 5 on that measure.
3.5 out of 5. So pretty good agreement. Did that translate into willingness to actually, invest based on what the AI recommended?
More like moderate agreement there. They moderately agreed with the idea of investing, based on the recommendations that scored a 3.05. And they moderately agreed they might choose an AI agent as a financial advisor in the future. That was 3.4. They also kind of moderately agreed the AI could identify low-risk stocks, 3.15, and that it could maybe help reduce financial literacy in Thailand, 3.30.
Moderate agreement sounds like cautious optimism. Like, okay, I see the potential, but maybe I'm not all in yet.
That's a good way to put it. And it showed up in the hypothetical investment question, too. They asked people, if you had 10,000 baht, how much would you invest based on this AI's advice? Most people, about 60%, said they'd put in between 1% and 20%. The median amount was 16.3%. So yeah, willing to dip a toe in, but not dive head first, matches that moderate agreement level.
Yeah, that tracks. Sees the potential, but maybe needs more proof or time. What did the participants see as the biggest benefits of using AI agents like this?
The number one perceived benefit, by a landslide, 85% of participants mentioned this, was that AI agents would reduce financial consultation costs. That lines up perfectly with the potential cost savings we talked about earlier. That was clearly a big draw. Other benefits people saw were the AI's ability to analyze huge amounts of data efficiently. That was 75%, and that it could provide advice that was easy to understand, 45%.
Cost, data crunching, clarity.
Nice.
Sense. Did the study look at how different types of people responded, like based on their investment experience or how familiar they are with AI?
It did, yeah, and that part was really interesting. Looking at figure 8 in the paper, it seems participants with less investment experience in Thai stocks were actually more likely to say they'd consider using an AI agent as their financial advisor compared to the more experienced investors.
Oh, that's fascinating. So maybe beginners see it as a more accessible way to get guidance.
That's the suggestion, yeah. It could be particularly appealing for people just starting out looking for direction. And then there was the familiarity with AI itself. People who said they were more familiar with generative AI tech, they were more likely to say they'd actually invest based on the AI's recommendations.
Okay, so comfort with the underlying tech builds trust in its applications, like financial advice.
It seems so. But what's also notable is that both groups, high and low AI familiarity, generally agreed the AI's analysis was reasonable, and both moderately agreed they'd consider using an AI advisor. So the core analysis was seen as sound, even if the willingness to invest varied with tech comfort.
Those are really useful nuances about who might adopt this first or find it most appealing. Now, no research is perfect. The paper itself points out limitations. What are the big caveats we need to keep in mind here?
Definitely. One major one is the evaluation period. It was only 1 year, November 2023 to October 2024. Like we mentioned, partly due to the LLM's data limits. A single year, especially that specific year, might not show how it performs over a full market cycle, through booms and busts.
Good point. Market weather changes things. What else?
Another is that the portfolio evaluation was kind of idealized. It assumed equal weighting, perfect monthly rebalancing. It didn't factor in real-world stuff like transaction costs, brokerage fees, potential slippage on trades. Those costs could eat into the actual returns you'd get, especially if the AI trades frequently.
Right. Real world is always messier.
Yeah.
And the survey. the people they asked.
Yeah, that's a key one too. The sample size for the survey was pretty small, just 20 people. And they weren't exactly representative of the general Thai population. They were mostly university students, often in finance-related fields. Their views, their tech comfort, their financial knowledge. It might be quite different from the broader public. Older folks, people less familiar with finance or tech, they might feel very differently.
Okay, so small, specific group for the survey. Definitely important context for those trust and perception findings.
Absolutely. But even with those limitations acknowledged, the study's main conclusions are pretty clear.
All right, let's wrap this up then. What's the bottom line? What's the main message from this research?
The study concludes that overall, these AI agents show significant promise as potential financial advisors, specifically in the Thai market context. They managed to outperform that passive benchmark in terms of return during the test period. They showed they could customize strategies based on user preferences for risk and style, and importantly, they got generally positive feedback on trust and explainability from that survey group, even with the caveats.
So framing it as a promising first step, maybe showing feasibility despite the need for more research.
Exactly. They see it as a foundational piece of work, marking the potential beginning of AI agent-driven financial advice becoming, a real factor in the Thai financial industry down the line.
So thinking about what this all means for you, listening. We've seen how these AI agents a step up from basic LLMs because they can use tools, collaborate, iterate how they can digest market data, tailor strategies, and start to earn a degree of human trust, at least in their reasoning. And all this comes with that really appealing promise of making financial advice potentially much cheaper and easier to access.
It definitely sparks some pretty big questions about what comes next, doesn't it? If AI, evaluated over just this 1 year, could beat a benchmark and tailor advice this effectively, how much better could it get? How will this technology evolve?
And what does that evolution mean for the whole financial advisory landscape? And maybe more personally for the future of how you manage your own investments. It really forces us to think about, well, the democratization of advice, how we define trust when money's involved, and what the role of human experts will be in a world with increasingly capable AI. Certainly leaves us with a lot to chew on.
Indeed it does. A lot to think about.
That's all the time we have for this deep dive.